If you're allowed 5 people on a basketball court, what team would go out there with 3?
Do you want an extra $7,000 a year for just simply filing a form with the IRS and tracking your money better? Your business is now buying real estate for you. I geek out on this stuff and I know the rules. I know how to play by that book.
All that profit could be tax-free to me if we do it the right way.
Correct.
Hey, welcome to Live Free, a show that helps people live at the intersection of health, wealth, and happiness. And today I've got one of my good buddies, Jeff Watson, here. So I've known you, Jeff, for 20 years, I think.
20 years.
20 years is crazy. Jeff's an attorney. He's an expert on so many things legal related, tax related. He's an advisor to me personally. He's helped me structure some of my companies in really creative, sort of outside the box ways to acquire properties and assets in businesses, but also to reduce taxes legally. I think the official IRS tax code is something like 60, 70,000 pages long. And most people think of the IRS as like, this entity that's out to get them. And they would look at the tax code as this terrible, collection of words that harms them. But if you look at it, if you think about it, around 90% of the tax code is actually a playbook for investors and entrepreneurs. It's basically a guidebook on how you can reduce your taxes legally. And I think that's a massive shift for most people. And so today I want to talk about taxes. I want to talk about how a normal person could reduce taxes and then how maybe an entrepreneur could reduce taxes. So somebody who has a business, who's successful, who's humming along, they're making a living, or maybe they're making a fortune. And there's some creative ways that they can drastically reduce their taxes. Jeff, you and I had a course a while back called HINT, right? High income, no taxes. So Jeff and I had this group, a coaching group, where we took entrepreneurs, so mostly, and we helped them structure their assets and businesses in such a way to legally reduce their taxes as much as possible, right? Because the more income you make, the more you pay in taxes. And I think Tax Freedom Day, it's late April, May 3rd, May 23rd.
Sometimes it's June or July.
Yeah. But what does that mean? I mean, that means
the average working guy up until from January 1st until Tax Freedom Day, late May, June, wherever, all that they earn from then to then goes to pay taxes. Federal, state, local, everything else. And so half the year is to pay taxes, the other half of the year is to live on.
So you're saying that if you have a partner, the U.S. government,
they are,
that the average American starts work on January 1st, and until sometime at the end of April or end of May, but depending on the individual, 100% of your income is going to pay taxes. So federal, state, and local taxes on your income.
Yeah.
So that doesn't sound like a good partnership, really.
It's a horrible partnership. Yeah. So it's a horrible partnership. And Greg, I'm going to reaffirm what you said, because there are 2 systems of taxation in this country. One for the uninformed and one for the informed. And you and I are here to do some informing.
Right.
Because ignorance is really expensive when it comes to taxes. What we talk about is we learn the rules, we play by those rules, and we use them to our advantage as much as possible.
Right. Like an example, if you're allowed 5 people on a basketball court, what team would go out there with 3?
Exactly.
Right? Most coaches be like, no, I need to get my full team out there. So in essence, that's what we're doing here is there's a playbook. It's the IRS tax code, right? And there are certain, advantages. There are certain things. So mostly entrepreneurs. Most of these rules, I mentioned 90% of this book roughly is dedicated towards helping small businesses and companies lessen their taxes. So in a perfect world, the death of taxes would happen sometime in the future. But I don't think we're going to live in that world. I think it's
not for a while.
It's one of these things that, as a patriot, you don't mind paying your fair share of taxes, but you don't want to be overly burdened by taxes. Again, because it's the greatest destroyer of wealth, ever invented. And we talk about the penny, right? That compounding exercise where if you take a penny and you double it in value every day for 31 days, so for 1 month. So on day 2, it's 2 cents, then 4 cents, then 8 cents, right? 16, 32, you keep going up. By the end of the month, you've got $10.7 million in that account. right? Which is pretty unbelievable. That helps people understand the power of compound growth and interest. But what happens when you apply a 25% tax to that gain every day? How much money do you think you
So
end up with?
during that same period of compounding, if every level of compounding is subjected to that 25% tax, you're going to end up with less than $200,000.
Yeah, because I think most people would guess they'd have around 7 or 8 million bucks, right? Because 25% less than that full amount. But when you tax, so every single day, like most Americans are paying tax every single day that they work, right? Every single year, that has a compound effect. And over time, over 20, 30, 40 years, over a lifetime, that's the single greatest destroyer of wealth. So let's pretend for a second that the death of taxes is not happening. We have this concept, this framework that we developed at Freedomology, which we call DIE, right? D-I-E. And basically, we look at all these ideas because there's literally hundreds, if not thousands of ways that we can reduce our taxes. And the 90-10 rule exists here. So 10% of these concepts will produce around 90% of the benefits. So we like to focus on those big levers versus the small ones.
Correct.
And I think we need to have two hats on, like the normal W-2 employee person and then the entrepreneur. So we're going to start with a normal person. But if you look at DIE, it's deductions, right? So legally, we're allowed to deduct a lot of things that most people don't even know you're able to deduct. There are instruments or investments, there are vehicles that we could put our money into that have massive tax advantages. So that's the I. And then the E would be entities, right? One of the biggest levers that we can pull is using entities, separate from yourself. So if you look at a person, you're a tax-paying, entity. You have a Social Security number, and the IRS tracks you by that number, and so you pay taxes. Well, when you set up a company, an entity, you have an EIN, so employer identification number, and now we can pay taxes according to that EIN. So your income can be distributed, and if you do it creatively, the right way, you can dramatically lessen your tax bill. So Jeff, let's talk about entities first, because I think that's one of the biggest things. So everybody that's a W-2 employee,
right,
should set up a company. I'm a firm believer that every single American should be an entrepreneur, whether that's a big business, small business, side hustle. Talk about that. What are the big, so what are the reasons?
So I agree. Let's just say you're going to do it on a small scale as a side hustle. You're going to spend no more than 8 to 10 hours a week doing this. Okay? So you're going to put down the Game Boy, you're going to put down the PlayStation, you're going to get away from Netflix, and you're going to do something. By creating an entity, it could be whatever name you want to call it, get your tax ID number and go from there. You now have the ability to claim deductions for reasonable and necessary expenses related to that income producing activity. The business has to have a goal of making money. The goal is to make money. Most businesses don't make money for the first 4 or 5 years.
Right.
So you've got the startup costs. Well, these startup costs can include going to networking events. These startup costs can include maybe the occasional meal, interviewing other people and networking. Maybe the startup cost includes mileage to and from places. So things that you would have often ordinarily paid with after-tax dollars, you're now paying for with pre-tax dollars because it's a reasonable and necessary, legitimate business expense for that entity. Mm-hmm. And whether it's delivering pizzas, doing Grubhub, Uber, whether it's mowing lawns, there's things that you can do that generate revenue, but also give you a deduction. And you can lower your tax liability as a result because you're able to take part of your cell phone expense. You're able to take part of your car insurance expense. You're able to take part of your home office deduction. You take a home office deduction. All of these things then on a Schedule C can lower your tax liability.
So it wouldn't be a normal person, a W-2 employee, the normal American, earns money through their job,
right,
pays taxes,
right,
keeps or spends what's left.
Right.
An entrepreneur, okay, they earn income.
They earn income.
They pay a lot of expenses.
Right, the cost of earning the income.
And then they pay taxes on what's left.
They pay taxes, they can pay taxes on what's left, or they can do other things with it, yes.
Yeah, well, they can make investments.
We'll get to that.
which we're going to get to. But I think that's the big aha for most people, and that keeps it very simple. It's You want to lessen your taxable income as much as possible. So
Right.
it's not inconceivable for someone watching that might be making $50,000 to $100,000 a year. They're paying taxes on 100% of that income as an employee, as a
Right.
W-2
Right.
taxpayer. It wouldn't be inconceivable for them to start a business. Now, this business, the goal of the business has to be to make money, even though most businesses, especially as you mentioned, the first few years aren't making money. So a business can actually lose money and you can still deduct that off of your personal expenses. So that's not an either or.
Yeah, and what the IRS is going to look at is a trend. Is every year is revenue going up? And are you closer and closer to making a profit? And if you can make a profit once in the first 5 years after showing, hey, my revenue keeps going up for years 1 through 4, year 5 I made enough to actually have a profit, everybody's good.
Right. But it's not inconceivable to think that somebody making 50 to 100K a year could start a side hustle, so should start a business, and can potentially reduce their taxes by maybe $8,000 to $10,000 a year if they're in a company trying to generate a profit.
Exactly, because Greg, remember,
With having the same lifestyle.
that person's going to probably be in the 22% tax bracket. And so for every dollar that they can say is no longer taxable, they get 22 cents for that. And so it doesn't take long for that to start to add up.
So Jeff, let me be a contrarian here. Is there a point where someone is taking advantage of the system, where they set up a business, but they're not really in business? They never had the intention to generate a profit, which is not what we're talking about.
Right.
Technically, at what point would the IRS say, you know what, this is a joke. You're just trying to avoid taxes. Is there a certain period, 3 years, 5 years, 10 years of loss after loss after loss?
Well, so I will tell you that there is a certain period of time that the IRS starts to get really aggressive, and that's about year 5. If you can't show consistently increasing revenue in that business and getting closer and closer to profitability, you got a problem. Now, you can have a business where year 3 you made a profit, and then year 4, 5, and 6 you lose money again. That's fine. There are certain categories of things that the IRS is very suspicious on, okay? Horses are something that they're very suspicious on, and hobby farming is another thing.
Hobby-based businesses.
Hobby-based businesses, that it looks like it's for more fun than for intent to make money. So you've got to really have that intent. You use the word quite correctly. You have to have that clear profit intent. You know, a lot of real estate investors on paper don't make any money.
Right.
But the IRS doesn't crack down on us because they know there's the intent to make money because we're holding a portfolio of properties that's getting better over time.
Exactly. They own property. You could theoretically you could decide today, I'm going to start, hey, I love real estate. I love all the potential income, the passive income, the tax advantages. And we're going to talk about that in a few minutes. And you could have the intent to make money, and then you're 3, 4 years into it, and so you've never bought a property, right? The IRS would or could audit you and look at that and be like, you know, scratch your heads. You're dealing with a human being, so you're dealing with the tax code playbook, but you're also dealing with the potential auditors. Like, are you really in business here, right? And so they could challenge that. I don't know that there's a ton of case law around that, but the goal here is to first, you're starting a business to generate extra income, to create independence, to make an impact in the community. It's not just to
create tax
avoid
deductions.
Taxes.
Right. You're doing it to create extra income that is not taxed as aggressively.
Right.
That's really what we're talking about.
Right. But you can. I mean, your vehicle, your gas, your airfare. If you're in real estate, the beauty of being a real estate investor is you could technically buy property anywhere in the world. You could, you know, when I travel to conferences, or even if I'm on a vacation, technically we don't write that off. But if I'm looking at real estate a portion of the time, then I document that. I keep track of it.
You have to document it, and it has to be a substantial portion of the time, right? You can't go take a trip to Hawaii, you know, write off 14 days because you looked at 2 houses. You can't do that.
Right.
You know, I want to be clear about that. But if you have if you're, for me, for example, if you would go to a conference in Hawaii or Puerto Rico, the conference is on Friday, Monday, Tuesday. You got the weekend off. Instead of coming back home to go back there again, you can stay there, and the whole trip, the whole time you're there, becomes deductible because you're there for work 3 out of those 5 days.
Okay.
because the primary intent was, the majority of the time, was work. 3 out of the 5 days you were at a conference.
Right.
2 of those days, well, it was the weekend.
Yeah, you're on the beach or whatever. Yeah.
You're not working. Yeah.
So Jeff, another powerful idea that normal everyday Americans should take advantage of would be to maximize retirement contributions, like instruments, investments. There are ways that we can take our money, our earned income, and have it lessen our tax liability. So let's talk about that.
Sure. There's a couple of different things that we can do here. I have a formula that I try and follow. I love Roth retirement accounts because once I get the money in there, it can compound like that penny, but it's not subject to the taxation. So I really go from 1 penny to 2 pennies to 4 to 8 to 16 to 32 to 64 and so on. That's the power of getting inside the Roth. And when I take it out of the Roth, I'm not taxed either. But you've got to put money into into one of these retirement savings accounts. They're incentivized to do it. If you put it into traditional, you get a tax deduction for doing it. I think the tax deduction now, in most people's case, isn't worth it unless there's also a corresponding employer match, i.e. putting into a traditional 401k. Otherwise, I'd say Roth, go first. So it goes match, Roth, and then back, once we've fully maxed it all out, you've pushed everything you can into your 401k plan, you've pushed everything into an IRA as well. Then if you got anything left, okay, then we can go back to the 401k plan again for more money. Because we got our match, then we go to Roth, then we can go back to the 401k.
So Roth has 2 out of the 3 tax advantages. So you don't get a deduction today.
Correct.
But you get tax-free growth, tax-free withdrawals.
Yes.
Traditional IRA has the other, or
you get
2 of 3. You get the deduction today, tax-free growth, but it's taxable on the way out.
Right.
Like a 401k. So what Jeff is saying, I agree with 100%. To the extent that your employer matches your 401k, maximize those contributions.
Get the match.
We're earning 100% rate
exactly.
return on that money. If
Yeah.
they match up to 3% and you make $100,000 a year, that $3,000 you're putting into that, they're putting $3,000 in. So you're actually having $6,000 go into that. So absolutely take advantage of that.
Exactly.
Right?
Exactly. Because when I take that $6,000 out later on, I'm not going to pay a 50% tax bracket on it.
Yeah. Jeff, there is this other vehicle instrument, health savings account, which in theory, some ways could be pre-tax, tax-free growth and tax-free withdrawals for a lot of things that you would need money for. So most people, I'd estimate less than 5% of the population has an HSA.
Correct.
Right? Health savings account. So
right.
What is it? Start from scratch. What is it? And how does it work?
Okay. So this is an area where there's so much confusion, Greg. I'm glad you asked this question. To begin with, a health savings account is an account you can open up once you have a high deductible health insurance plan that is HSA compatible, health savings account compatible. You've got to get the right health insurance coverage because the HSA is designed to pay the deductible and other things that the insurance doesn't normally cover. Okay? That's you must have that type of insurance plan. Mm-hmm. And so if you have a job, go back and find out if you're covered under health insurance. Do you have a choice of getting a high deductible HSA compatible plan?
So most insurance programs have that option. You have
Correct.
to select that option during the enrollment period.
And the key to that is normally that premium is cheaper than the other one. The drawback is there's a problem. You got a bigger deductible if something goes wrong. So that's why Congress says, okay, you're saving money on the premium. Keep that difference of the premium savings, push it into your HSA plan, and in about a year, you're going to balance it out. You'll have enough in the HSA to cover the deductible. Great.
So if you're young and relatively healthy,
it's a must-do.
That option, and HSA should be a vehicle. What can you use it for on the back end? I mean, you could use it. I've heard of people using it for saunas, for the sleep mattress, different aids to help you be healthier.
A health savings plan or health savings account you can take tax-free withdrawals from that account for qualified medical expenses, deductibles, co-pays, doctor's visits, physical therapy, chiropractors, eyeglasses, anything that a licensed medical practitioner prescribes for you. Keywords there, licensed medical practitioner prescribes.
So Jeff, you can get your doctor to prescribe a bed?
There are cases where doctors have prescribed bed. I've litigated these. Let me explain. Let's say you've had a chronic back problem. You've got degenerative disc disease. You've got spinal or canal stenosis. Maybe you even had a back operation and it didn't succeed, and you have chronic back problems. Your doctor, your orthopedist, your physical therapist, your physiatrist can prescribe a certain type of mattress that provides better comfort and support for your low back because you've got a clearly documented medical condition and this treats it.
So if you can get your medical partner to say that you're going to need certain vitamins and minerals and supplements to help with one of your biomarkers, help improve the health of your liver, or help you lose weight. So a sauna, a mattress, these are outside the box things that most people would just pay for after tax. But we're saying strategically, if you have an HSA, you can pay for pre-tax. And Jeff, again, I want to remind people that this money went in pre-tax.
Went in.
It grew tax-free, and you're paying for these things with no tax as you're taking the money out, as long as they're used for those expenses.
It's a teeny bit better than that, Greg.
Okay.
It goes in pre-tax and you get a tax deduction for putting it in because it's not taxable to you.
Yeah, correct.
Yeah.
So pre-tax, yeah.
And then it can grow tax-free if you invest it, like you and I talk about how to do investments. And then as the income comes in, you can use that income to pay for these necessary, reasonable medical expenses that your doctor prescribes.
So you're taking that money out and not paying taxes
Right.
on that mattress for $2,000 or $4,000
Yeah.
Okay.
And if you've got, I'll give you another example. If you're like me, you need help, you need eyeglasses. My eyeglasses are always purchased with tax-free dollars.
Yeah.
The other thing that
It's
is
not surprising.
the other thing that is, you use the word sauna. If you've got a medical condition that is correctly treated under the normal standard of care with a sauna, bang, doctor prescribes, you do it at HSA deductible. But I want to be clear. I don't want people to think that this is some wild, wild west. No, it's got to be under the norms of a standard of care for that particular type of practice.
So your medical partner.
Yeah, your medical provider, yeah.
Okay.
I mean, but nutrition is an area that we're finally waking up to in America as we've got to put the right stuff in our body with the right supplements. And when doctors start prescribing that, and more are, there's reasons you can use your HSA dollars now for that stuff.
Right, that's amazing.
Yeah.
Jeff, let's jump to the life of an entrepreneur. So let's transition to what I think are some of the more exciting. Again, most of the tax code designed to create a playbook for business owners, small businesses, big businesses. There's C Corps, S Corps, LLCs, limited partnerships, trusts, dynasty trusts. There's all these entities, there's all these ideas. But I think if we keep it simple, if we look at deductions, the most impactful deductions that an entrepreneur can take, if we look at the most impactful investments that an entrepreneur, I have some thoughts that I don't know, I want to hear your thoughts. I have some thoughts. And then if we look at entities, so we look at asset layering, and maybe you set up an LLC and it's being taxed wrong. Or, in many cases, it makes sense to have a C Corp as one of your entities, and you're doing a certain type of business through the C Corp. You're taking advantage of that model. But I think for most people, having, an easy to set up LLC taxed as an S Corp probably makes the most sense. Why is that such a powerful concept?
That is a very powerful concept, and I think the best way to explain that is to tell somebody to pause the video long enough to go find your most recent pay stub and look at that pay stub and circle or highlight the stuff that went out for FICA, FUTA, and unemployment. Just look at those numbers. FICA is Social Security tax. A LLC that elects to be taxed as a sub S, and any LLC that's making between $65,000 on up in gross revenue,
which is not high.
It's not high. It's a little over $1,000 a week, Greg.
Yeah.
That owner needs to look at seriously considering electing a sub S tax status, because then when they take the money out for themselves, they can take it out two ways. They have to take out a reasonable salary. The reasonable salary is based upon what would you pay somebody else to do that same job for the same number of hours. Okay? Then anything else that they can take out is taken out as a owner's distribution. an owner's profit distribution. That owner's profit distribution is not taxed at FICA, FUTA, unemployment rates. And that's a 15% savings right there.
Every year, potentially.
Every year. So let's just say you make $100,000 in your sub-S entity and you're taking 50 out to pay yourself. The other 50 goes back into the business, cost of goods services, all the other deductions that you're running and so on. So you're taking out $50,000. You're going to take out a $25,000 salary and a $25,000 profit distribution. You're going to pay substantially less taxes doing it that way than if you took out $25,000 as a salary and it was all subjected to that extra 15% for FICA, FUTA, etc. Now, Greg, let me be clear about this. When you take out the 25 as a salary, you're paying income tax and Social Security taxes on it.
All those other taxes.
All the other taxes. When you take out the profit distribution, you're going to pay income tax on it, but you're not going to pay all the other stuff on it. And so it's a 15% savings. So 15% off of $25,000 is you know what, $7,000 a year? Do you want an extra $7,000 a year for just simply filing a form with the IRS and tracking your money better?
Correct. I would. Yes.
Absolutely.
Right. And obviously, it's more magnified if you're making $500,000 a year or $1 million a year.
Greg, then it skyrockets exponentially because just think about it. If you're making $500,000 a year, you're paying yourself $100,000 salary, $400,000 comes out as an owner's distribution.
Right. Right.
That's you're not
And
even
you're playing by the rules of the playbook.
You're playing by the rules and bending it in your favor as legally allowed to.
You're putting 5 men on the court.
Exactly.
So to speak.
You're putting your 5 best men on the court.
Playing undermanned. Okay.
Yeah.
So let's talk about real estate because I think there are a lot of high income people out there. So W-2 earners who might be a professional, could be providing a service, but the majority of their income is taxed as ordinary income, right? Is W-2 income. And so if you're making $100,000, $200,000, $300,000, $400,000, $500,000 a year, it absolutely makes sense for you to start investing in real estate. It makes sense if you're trying to create wealth to start investing in real estate. Obviously, we're huge fans of real estate. The goal, I think, is to create an income-producing asset. Most people, if they want income, but they also want independence, because how many people do we know that have super high incomes but no independence?
No independence.
So they're working 70, 80 hours a week in this hustle culture mentality, and that can be like a disease, right? So if we're looking for independence, we're looking for impact. Let's talk specifically about real estate, passive income. Talk to me about what does a real estate professional mean exactly? What is passive income?
Okay.
What is rental income?
Wow, those are 3 different categories, okay? So let's talk about passive income. It's passive in the way the IRS looks at it. It's income that is not subject to self-employment tax because they don't see you actively going out and earning it. Is it completely passive? No, you got to pay attention to what you're doing.
Sure.
Okay? But it's taxed better and more favorably under the tax code, and we like that. Okay, we don't want to have as much money taken from us by the government. So that's one of the advantages there. So passive income coming off of rents is that way we're doing it. And rents, and the other thing that we want to look at is interest income is also not subject to Social Security, self-employment taxes. So that's something else to look at. That's another form of a passive income that sometimes flows to real estate investors. Now, the rules about becoming a real estate professional are very, very specific. And this is an area that the IRS consistently wins on when people try and go outside the rules. You've got to know those rules, okay? You've got to be able to prove that that is your primary business activity as a real estate agent or investor, broker, etc. You've got to be able to document you've spent the requisite number of hours, 500 hours in a year. You've got to be able to prove that that is your business. Okay, those are the things you got to look at. Now, the beauty of it is, for a lot of these high-income couples, only one of them has to be the real estate professional. The other one can be the brain surgeon, the cardiothoracic, can be the shipping manager, can be the entrepreneur, etc. And if they file jointly, they get the benefit of one of them being the real estate professional.
What are the advantages of being a part-time real estate investor compared to being a real estate professional in the IRS's eyes?
Okay, so a normal real estate investor can take deductions and losses for depreciation, interest expense, and repairs and maintenance, and then they're capped at $25,000 negative number on their Schedule E. That can then come over and lower their overall taxable income. That's the normal real estate investor. A real estate professional is not capped at that $25,000. That ceiling goes away, and so if the negative number is $100,000 because of depreciation, bonus and component depreciation, then all $100,000 reduces their income.
Okay.
None of it gets canned up and carried forward.
Okay. Let's talk about bonus depreciation. Let's talk about some of the more advanced ways that if you're going to jump into the business of real estate investing, most people do it with the intention of, passive income, they want rental income, they want to produce income that's not dependent on them to produce it, right? They want to buy an asset that can produce this passive income, this rental income.
Right.
And they're hoping that that asset goes up in value. So it's really two reasons. It's income primarily, and then appreciation. And I think that's completely an amateur way to look at it, because the third reason, the depreciation and the accelerated depreciation that you can use to offset your other forms of income, can be massively substantial. So let's walk down that path.
You and I might be a little different. I'll give you my perspective. I buy assets that generate cash flow. Okay? They've got to give me some degree of cash flow, because they got to pay for themselves, and I want a little bit of compensation for the aggravation of being involved.
Correct.
So after that, I then look at the appreciation as, yeah, baby, someday I'll get to it. Mm-hmm. But in the meantime, in addition to the cash flow, I get that depreciation that you were just talking about, and that makes the hassle worth it, because it drives down all my lawyer income that I otherwise would pay taxes on.
We're 100% in alignment.
Yeah,
we don't look at this. We look at this exactly the same way. And I think most people, even real estate investors, people who are new into real estate or have been doing it for a few years, they don't fully realize the depreciation benefits of owning real estate. So there are some,
I'm going to call them clowns, that are out there that say, go buy it for the tax benefits.
Yeah, no.
And you and I are like, no, it's got a cash flow.
Yeah, it has to pay for itself or make money.
Yeah.
Right? And the only example, if you're in a market where, highly appreciating market, where you're almost certain it's going to appreciate in value, because maybe you bought it at a price, it's substantially less than market value, and the appreciation is going to be high, so your goal is to hold this thing for 5-10 years, and maybe it just breaks even. So we're talking about three things here. But
break-even cash flow, I can tolerate.
Yeah, so exactly. But most people would want to produce positive rental income, positive passive income. If you look at one of the first deals that I did, the building Freedom Square in Parma Heights, so 24,000 square foot building, I bought in 2004 for $1.6 million. I sold it 18 years later for $1.35 million. Now, so if you would have asked me 20 years ago, hey, Greg, you're going to pay $1.6 million for this thing. You're going to sell it in 18 years for $1.35. So you're going to lose $250,000 when you sell this building. I would have said, no way. I'm going to run away. There's no way that's a good investment. Okay. So the appreciation, in my mind as an amateur, the appreciation was a big part of why I was investing in any piece of real estate. But in reality, that building allowed me to become financially free, because it was pretty much unoccupied. 5 of the 16 units were rented out. The owner, it was an owner finance deal. So I actually gave him $250 to put down on the property, and he financed the rest. So he financed $1.35 million for me. It's 6% interest only payments for 5 years. So I think if I remember right, it was $67.50 a month, my payment to him. And then I had my taxes and insurance and maintenance. But when I filled that building up, I worked really hard to fill the building up, over 12 months. So I went from 5 units to 15 units rented out at $1,200 to $1,500 a month. So that building was producing over 20 grand cash flow every month, right? So gross rental income. I had about 10 grand a month in expenses. So that building was producing $10,000 a month. I mean, that was the first time that I looked at Kelly, my wife, and was like, so we're free. Like we don't have to work anymore. Now we were just getting going with Real Flow, and I was in late 20s, early 30s. So I wasn't about to retire, but we named the building Freedom Square because of the financial freedom it gave to me, to my family. It allowed me to coach the boys when they were younger, right?
Right.
And then
it'll let you change your schedule.
Yeah, completely. It gave me that sense of independence. And if I look at then, as I've developed, extremely high incomes over the past 20 years, the depreciation from that building, right? I was so able to use regular depreciation with commercial property, it's 39 years.
39 years.
So in theory, if you buy a building for $1 million, the IRS will let you deduct that $1 million over a period of 39 years. It's a simple formula.
Yeah, you take out the land out of the purchase price, but yeah.
Yeah, okay. But if you use accelerated depreciation, component depreciation, so Jeff, what is this? So we did it on that building. We do it on most of our properties. What is component depreciation?
Sure. Component depreciation is when you buy a property, whether it's a house, apartment building, office building, warehouse, whatever. You then hire an expert to come in and evaluate the property and determine the value of certain parts of the overall property.
So components.
Components, yeah. That's why we call it componentized depreciation. That's one of the words for it. So what's the roof? What is the HVAC system? What's the electrical? What's the plumbing? We break it all apart, and then we put these on shorter depreciation schedules. 7 years, 10 years, 12 years instead of 39 years.
So an example, a furnace, they would identify the value of the furnaces in each suite and say that furnace has a life expectancy of 7 years. So that's got a $10,000 value. So you can now deduct that. So you can accelerate the depreciation.
Correct.
Essentially.
Yeah. Yeah. And so instead of taking that $10,000 and stretching over 39 years, you're now able to take it over 10 years.
Yeah.
So you get a bigger deduction every year.
So we had a situation recently where I had a very high income in the past few years, and we use component depreciation.
Don't you hate it when that happens?
Yeah. No, it's great. It's great. But we use component depreciation on one of our commercial assets, and we were able to identify $300,000 in deductions that we wouldn't have used otherwise. So it reduced my taxable income by $300,000. And
correct.
That's what we're talking about here. So that's the beauty, that's the power of real estate is yes, it's a real business. So there is investing in real estate. I think you should put the hat on like, hey, I'm going to be a real estate entrepreneur. I'm going to jump in the business of real estate because it is a business.
And I'm going to take a little twist on this because you and I have both done this. If you're a licensed professional and you run your own company, or if you're an entrepreneur and you run your own company, you really should, through another entity, own the building that your company's in.
Oh, 100%.
Because then you can do all the strategies we just talked about, and your business is paying rent to your rental company, two separate legally distinct companies. You do an arm's length transaction, you've got a normal lease, you pay market rent, but it is a fantastic, powerful maneuver because your business is now buying real estate for you.
Right. And it's siloed.
Right.
So from an asset protection standpoint, it's separating your business from the entity that's holding the real estate. So if you get sued in one or the other, you're putting insulation between the two.
Correct.
So Jeff, can we use that idea for regular residential investing? If I want to be a landlord and buy some houses or buy small apartments.
Let's put it like this. So say I'm a real estate investor and I now have 10 doors I'm managing, 10 single family houses I'm managing. I might move my real estate business into one of those properties. And that property may now pay rent. I may now have to pay rent to my real estate company over here for that. So
sure you would have two separate assets.
Right. You'd have
a holding company that owns the asset.
Right.
And then you have an operating company that's separate, completely separate.
Two separate businesses.
They can work together.
Two separate tax returns that they work together.
Right.
And you can do, if you can do that, you can do that. You don't have to have a professional office building to do that. You can have a mixed-use commercial building. You can have a single-family home. I know lawyers that buy homes in the nice area of the small town, fix it all up, and they rent, their law practice rents half the house, and they rent the other half to another tenant. Dentists and doctors have done that in small towns all over America. The beautiful thing is, with a house like that, you can still componentize it. It's not going to be as big in numbers.
Right, but
it's still the same principle.
But it will accelerate it.
It will accelerate
it. Will help you.
Yeah. It might be one less zero, but it still moves the number the right way.
And there are certain companies that will charge a percentage of your tax savings. I would not work with those companies.
Neither would I.
Component depreciation type companies. We actually have worked in the past with one, and they saved us about $100,000, but they wanted 30% of the tax savings. We paid the bill, and we were upset about it. And then the next time we did it, we hired an independent contractor, outside consultant that just charged a flat fee, a few $1,000s, to save these few $100,000 in taxes. So there's a right way and wrong way to approach this. Jeff, let's move into one of our favorite topics, which is self-directed IRA investing. So this is an area, again, I'd say most people don't use self-directed IRAs, and even the ones who understand or think they understand, they don't get the wide breadth of potential investment options so that they can take advantage of. So the list is so big that the IRS doesn't give you a list of everything you can do for all these investments that you can.
Right.
They assume you can do everything except for this small list of things you can't invest in.
Correct.
Like art or collectibles or coins. You can't self-deal, so there
life
is a
insurance policies, things like that.
A transaction concept. So let's talk about that. Give me your high-level overview of what it is, and then I want to talk into some specifics.
Sure. So I'm gonna say something that's just a teeny bit surprising to a lot of people. Every IRA is self-directed, but most people don't know it because they don't know that they have a choice of doing something other than stocks, bonds, mutual funds, and ETFs. You can put your money there, and I suggest you put some of your money there. But you can also self-direct it, and there's probably about 50 different companies in the United States of America that specialize as a custodian or administrator, licensed and regulated by the IRS, that will allow you to put your IRA money with them and then go invest in all sorts of things. Whether it is, I've got clients that own stud bulls. I've got clients that own...
So animals.
Other kinds of animals, yes.
Okay.
I've got multiple clients that have invested IRA dollars into animals. I've got clients that invest IRA dollars into apartment complexes, shopping centers, single-family homes, startup businesses. I've got a guy that just funded into a platform that may compete with GoFundMe.
So Peter Thiel, Jeff, with PayPal, he took $1,700 and he used his Roth IRA to buy his founder shares in the company. And I think a few of the other
Elon Musk did it. Max Levchin did it, and two other gentlemen whose names I can't remember right now. I always consider them the PayPal Five.
Yeah.
And they all did the same thing.
PayPal Mafia, right?
Yeah.
And so Peter Thiel made that investment with his Roth, which means any growth is tax-free and any withdrawals are tax-free past age 59 and a half, right? So he didn't need that money necessarily today.
Correct.
So what happened is that sub $2,000 investment is worth over $5 billion today, completely tax-free.
Because he took everything he made completely tax-free from when PayPal went public on the IPO, and he kept it all inside of his Roth account and reinvested in other things. He rolled some of it into Facebook with Zuckerberg.
Yeah, so technically, Jeff, he did not own his founder shares of PayPal.
He did not.
His Roth IRA did.
His Roth IRA owned it.
Yeah, okay.
You can buy founder shares in a company and do that. Now, if there's income generated, there's some issues with unrelated business income tax. But when you go from $1,700 to hundreds of millions, I'm willing to pay a little bit of tax on the income in between.
So Jeff, now technically, as I've done the research on this transaction, because it's a fascinating one, you can actually still work for the company. He still worked for the company. Peter Thiel, as an individual, was paid a salary, was paid an income. His Roth IRA is the entity, the separate entity from him that owned his shares in the company. That can be two separate things. I think the IRS looks at a majority ownership. So for example, let's say there wasn't 5 guys that started PayPal. Let's say there was just one. He wouldn't have been able to do
Would not have been able to do it.
Okay. So it is a minority interest.
Correct.
To avoid this self-dealing, this prohibited transaction concept, which is
And Greg, I got to tell you, because I've studied this thing too from the tax angle, And if the IRS knew then, when they audited this transaction, what they know now, they would have gotten him. Because we didn't know then how the IRS was interpreting the code. We now see where they're going, and so we adjust how we structure based upon that. Because Greg, you know this is what I do on a regular basis. Right. I mean, I'm involved in an IRA deal almost 4 times a week for either myself or a client.
So let's go over some of the more creative ones.
Okay.
Maybe outside the box ones, right? That have to do with either real estate or business. I want to focus it on income producing assets.
Right. So I see a lot of people take tax qualified money, 401ks, IRAs, SEPs and Simples and things like that, HSAs. They buy real estate, single family homes, into apartment syndications. They do other things with it. They'll invest in company startups. They'll do loans. I know people that have taken small amounts of IRA dollars, let's say $100,000, and through in a consistent, wise, prudent, hard money lending process, have now taken that 100,000 and grown it to 2 million. It took them about 7 years. Okay. I've seen other people that started out with, say, 800,000 in a 401k plan, did the same thing, and now they're at 5+ million because they're doing loans. Most people don't even think you can do that with your IRA.
Right. And Jeff, I think the beauty of this is these are not loopholes. These are not weird things that you're trusting the guidance of one person that you heard about on the internet or you watch a video. These are all within the rules of the playbook on what you can and cannot do.
So now we're going back to the rules, the playbook, the IRS tax code, the playbook. There are only 5 or 6 sections of that playbook that I'm really good at. Okay? And 3 of them have to do with IRAs. 26 USC 408, 408A, that sets up Roth IRAs, and then my all-time favorite, sarcasm, 26 USC 4975. I know those rules really, really well.
Why is it your favorite?
Because I geek out on this stuff, and I know the rules, and I know how to play by that book.
Yeah.
Okay?
But what specifically in that makes it your favorite?
Because 408 creates IRAs. 408A created the Roth IRA. Mm-hmm. And then 264975 is all the rules about what you shouldn't do. And so if you don't do the no-nos, everything else is go for and prosper. Right.
So thinking outside the box here, as long as, so you're not related to me.
Correct.
One of the main prohibited transactions are self-dealing. Using your Roth IRA to benefit you individually, not just your Roth. That's the essence of the rule. Or your linear descendants, like your parents or your kids. But your brother is not a linear descendant. We're not even related. So we're not brothers. Right. So if we set up a company and you own 51% of it or 60% of it, and I own a minority, then I could use my IRA to help fund it. You're operating it, you're running it, but I believe in you.
Right.
We grow this company into something big over the next 5 years. All that profit could be tax-free to me if we do it the right way.
Correct.
That's such a powerful idea.
It is. It's huge. And this is where we see people that literally, by learning these rules, identifying the right investment, can change their family financial tree for generations.
Right.
Generations. I mean, the guy that started with $100,000 in his Roth IRA and now has over $2 million. Do you think that changed his legacy?
I mean,
absolutely.
Yeah.
Because that's $2 million tax-free, Greg.
Yeah. So let's talk about that. 59 and a half. So if I'm in my 20s or 30s, so even in my 40s, I might be thinking, hey, I'm not rich yet. I'm not wealthy yet. So why would I use IRAs? Why? I'm more concerned about paying the bills. I'm more concerned about buying the vacation home, about owning the nice house and the car. Like, I want to produce real income right now. So in most instances, when I set up an IRA, I really can't use that money until I'm of retirement age. So 59 and a half, there are some exclusions, but they're small, right? Or for medical so issues or whatever. However, an inherited IRA, if my parents, so if they set up an IRA with me as the beneficiary and they pass away and I inherit an IRA at 25, 30 years old, or I set one up for my children, so my 3 boys, and I pass away and they inherit that IRA, no matter what amount of money is in that IRA, they don't have to be 59 and a half to access and use that money. That's a crazy.
Correct. Now, the rule has changed in the last few years. So the inherited IRA, whenever I get an inherited IRA, what year did you inherit it?
Right.
Okay? Because under the new rule, you have to take the money out over the next 10 years.
Right.
You have to take it all out over the next 10 years, but you have to take it all out tax-free, Greg.
Right, in a Roth.
In a Roth,
example.
in inherited Roth.
So what about traditional? Do you have the 10-year rule with traditional?
10-year rule with traditional, unless you're the surviving spouse, or a couple of other little exceptions. But when the money comes out of the traditional, it's taxed. Okay? So we don't like to grow traditionals because we're just growing a tax bill. We'll take it out, reinvest it back into our own Roth, and let it grow that way.
Yeah, in almost all instances, it makes more sense to put money into a Roth than it does a traditional. Especially if you're self-directing and you're thinking that you're going to earn more than 6% a year or 10% a year. You have the potential to earn, 20, 30, 100% return on your money in a year if done the right way.
I'm sitting here trying to think of a reason to justify putting money into traditional, and the only thing I can think of is if it's a traditional 401k to get the employer match. That's the only thing I can think of.
No, I would agree with
that.
I would agree with that. So Jeff, if I inherit an IRA,
Roth or traditional?
So let's say Roth.
Okay.
And I'm not 59 and a half. And who I inherited from, they pass away. So it's mine. It's now in my name. So what year is it if I can take the money out over my lifetime versus the 10 years?
Good question. The Secure Act was enacted in late 2019. And so it drew a line as of January 1st of 2020. Anything inherited after January 1st of 2020 from a non-spouse, you had to take out in 10 years. Anything inherited before January 1st of 2020, lifetime.
And you could
lifetime.
So you could technically keep making investments. It's my IRA.
You've now become
42 years old, and I want to continue to make investments. I inherited $100,000, but I think so I can turn that 100 into $1 million. It's tax free. I can invest in businesses that income potentially.
So you take the 100 in an inherited IRA that you inherited back in 2019, because that's when the person passed away. You grow it to $1 million, and then you put that $1 million to work where it hands you $10,000 a month every month. That $10,000 is tax-free every month for the rest of your life. And then it goes to your heir that you name as the secondary beneficiary, and they've got 10 years of that.
So I got another question. If I have an IRA that might have $150,000, I think there's a lot of people out there who have money in retirement accounts or money in IRAs. Maybe they've left an employer and they've moved it over to an individual retirement account. So they might have $100,000, so $200,000, so some substantial amount. Should they convert it to a Roth?
They need to have a plan to get it to a Roth. They need to have a plan. It's something you strategically have to think about. You want to get to a Roth no later. You want it all to be Roth dollars no later than age 72, so that the new RMDs at age 73 do not hit you adversely, and you can have flexibility whether you take it out or not. Because when you take money out of a traditional, anytime after 59 and a half, you're going to pay taxes on it. You want to have a plan of how to convert. Now, after you make the conversion, you got to let the money sit there for 5 years, and then it becomes tax-free when you take it out. So anybody that is 55 and younger, it's much easier to strategically do those conversions. Anybody between 55 and 67, that's the window most people are. We've got lots of tools that we can use to do that. You get over 67, we've got to start looking at, does it really matter? Because the key here, Greg, is can you convert at a discount, and can you grow fast enough after you convert to make up for the tax liability you paid? Because when you do the conversion, it's a taxable event. But if I can lower the taxable event through discounting, and I can stagger it over time, I can probably get away with it to where there's no tax liability or very minimal.
Jeff, man, we've talked about some amazing concepts. So we've talked about deductions. We didn't even really get to tax credits or opportunity zone investing. I think we're gonna have to get back together in the studio and just talk about some of these other ways, these other deductions that you can use. But I think deductions, these instruments, these investments, these entities, and there are some really exciting ways that you can legally reduce your taxes. And I think that's the power here, is that So taxes don't have to be this dirty concept that you run away from.
Right.
They can be something that you can take advantage of, and you can make sure that you have 5 men on the court at all times and you're playing the game within the rules. I
look at it, Greg, first of all, the collective combination of your experience and my experience, our educations and so on, is over 50 years of thinking about how to run businesses in a tax efficient manner, and how to minimize your tax impact. So you can't get 50 years into 50 minutes. Sorry, you just can't do it. We got to come back. We have to have another conversation. But I agree, you should not ever be afraid of taxes, because you should be able to get to a point where you've got enough working knowledge of how to minimize those taxes to a point where they're not robbing you of your opportunity to build multi-generational wealth. Mm-hmm. If you don't do anything about your taxes, it's so hard to build multi-generational wealth. If you're aggressive and wisely aggressive on your taxes, not any of these crazy schemes that we see promoted over the internet, but wise, aggressive maneuvers that you have multiple people verify, your accountant, your attorney, there's ways of doing that and building multi-generational wealth in one generation. You've done it. I'm doing it.
No, it's crazy. So you don't want to stick your head in the sand. You want to be curious. I think curiosity is not going to kill the cat in this example. You need to talk to people. You need to open up your mind and just expand your thinking as it relates to taxes. And again, you just have to see that taxes are legitimately the greatest destroyer of wealth. So how can you minimize legally the amount of taxes that you have to pay each year? So Jeff, thanks for visiting with us today.
Yep.
The whole goal at Freedomology is to help people live at the intersection of health, wealth, and happiness. And I think when it comes to wealth, right? So income is extremely important. So independence, that's huge. But impact, and you have a greater chance to make a big impact if you're reducing your tax obligations every year, especially as we teach you success, as we teach people how to create income producing assets. You're going to have an income problem and you're going to have a tax problem. Or if you're an entrepreneur right now and you're paying a tremendous amount in taxes, then get creative, be curious, dig in and learn from experts like you on how to reduce your taxes.
Be curious, learn a few pages out of the playbook, see how it impacts, go do a few more pages, see how it impacts and go from there.
Yes, action, learn.
Yeah, right? Because I look at it this way, it's a layering effect for me. It's 25 years of strategic layering to where I have a very minimal tax footprint.
Yeah, cool. Well, thanks guys for visiting, and we'll see you soon.